What if someone took $28 billion and used it to prove a mathematical theory? That's exactly what happened. James Simons spent 30 years testing whether markets could be understood through probability rather than intuition. His firm, Renaissance Technologies, became the most successful quantitative hedge fund in history, generating average annual returns of 39% before fees from 1988 to 2018. But here's what makes this fascinating. Simons wasn't trying to get rich. He was testing a hypothesis. The mathematician-turned-investor wanted to know if financial markets followed patterns that could be decoded through statistical analysis. The $28 billion his flagship medallion fund generated for investors wasn't the goal. It was the evidence. I've spent the last 6 months analyzing interviews, academic papers, and documented strategies from Simons's career. What I discovered were 4 specific principles that radically differ from conventional financial wisdom. These aren't get-rich-quick schemes or market timing tricks. They're mathematical frameworks that challenge how most people think about building wealth. The reason I'm investigating this today is simple. According to data from the Federal Reserve's Survey of Consumer Finances, approximately 67% of American households approaching retirement age have less than $100,000 saved. Meanwhile, the S&P 500 index has generated average annual returns of approximately 10.5% over the past 40 years. The mathematical disconnect between what's possible and what's actually happening fascinates me. Simons operated from a fundamentally different premise than traditional investors. While most fund managers relied on intuition, market predictions, and quarterly earnings reports, Simons approached investing like a physics problem. He hired mathematicians, physicists, and computer scientists, not MBA graduates from business schools. His team included a computational linguist, a cryptographer who worked on speech recognition, and experts in machine learning before that term became mainstream. Here's the critical distinction. Simons never claimed to predict the future. Instead, he focused on identifying mathematical probabilities in patterns that repeated themselves over time. According to research published in the Journal of Portfolio Management, this probabilistic approach to markets differs fundamentally from predictive approaches in one crucial way. It acknowledges uncertainty as a permanent feature rather than a temporary obstacle. The 4 principles I'm about to walk you through represent decades of mathematical testing with billions of dollars at stake. Each principle challenged conventional wisdom when Simons first implemented it. Each principle has since been validated by academic research from institutions including MIT, Stanford, and the University of Chicago. And each principle is accessible to anyone willing to think mathematically about money. Before we dive into these 4 transformative insights, let me be absolutely clear about what this analysis is and isn't. This is an investigation into mathematical frameworks that govern wealth accumulation over time. This is not financial advice tailored to your individual situation. I'm examining documented principles that Simons used to generate extraordinary returns, and exploring how those principles might apply to systematic wealth building. Nothing here constitutes a recommendation to buy, sell, or hold any specific investment. The first principle that Simons emphasizes is something he wishes someone had explained to him when he first started thinking seriously about wealth. Eliminate emotion from every financial decision. Here's what Simons discovered through mathematical analysis. Emotion is the single largest destroyer of wealth in financial markets. Not fees, not taxes, not market crashes, emotional decision-making. According to research from Dalbar, which analyzes investor behavior across millions of accounts, the average equity investor underperformed the S&P 500 by approximately 3.9 percentage points annually over the 20 years ending in 2022. Think about that mathematically. If the market returned 10% annually, the average investor captured only 6.1%. Over 20 years, this difference compounds dramatically. Let me show you the math. If you invested $10,000 in an S&P 500 index fund that grew at 10% annually for 20 years, you'd end with approximately $67,275. But if emotional decisions reduced your actual returns to 6.1% annually, you'd end with only $32,740. That's a difference of $34,535, or 51% less wealth, purely from emotional interference with mathematical processes. Simons recognized this pattern early in his career. According to interviews he gave to the Wall Street Journal, he observed that even highly intelligent investors made irrational decisions when their own money was at stake. They would abandon proven strategies during market downturns, chase performance during rallies, and constantly second-guess systematic approaches based on recent news or gut feelings. The solution Simons implemented was radical: remove human emotion entirely from the investment process. Renaissance technologies made decisions based purely on mathematical signals generated by computer algorithms. No trader could override the system based on a hunch or a feeling about market direction. No portfolio manager could abandon the strategy during scary market conditions. The system executed trades based on probability, not psychology. What's fascinating is how this applies beyond professional investing. According to research from Vanguard analyzing hundreds of thousands of retirement accounts, investors who checked their portfolios most frequently achieved lower returns than those who checked infrequently. The study, published in 2019, found that investors who logged into their accounts daily underperformed those who logged in monthly by approximately 1.5 percentage points annually. Why? Because frequent checking triggered emotional responses to short-term volatility. Here's a specific example that demonstrates the mathematical cost of emotional decision-making. During the market crash of March 2020, when the S&P 500 dropped approximately 34% in just 33 days, millions of investors sold their holdings near the bottom. According to data from Charles Schwab, trading activity increased by over 300% during that period, with most trades being sales rather than purchases. Those who sold and moved to cash missed the subsequent recovery, which saw the market not only regain all losses, but reach new highs by August of that same year. An investor who held through the volatility and stayed invested would have recovered completely within 5 months. An investor who sold in panic and waited for clarity before reinvesting likely missed substantial gains. The mathematical difference. According to analysis from Morningstar, investors who sold during the March 2020 crash and didn't reinvest until they felt comfortable likely missed returns of approximately 40 to 50% over the following 12 months. Before we continue, quick question. Are you the type of person who makes financial decisions based on data or based on feelings? If you said data, subscribe to this channel right now, because everything I share is backed by research from institutions like the Federal Reserve, the Bureau of Labor Statistics, and peer-reviewed academic journals. I don't do speculation or hype. I investigate mathematical frameworks that govern wealth accumulation. Hit that subscribe button if that approach resonates with you. Simon's first principle leads directly to his second insight, which builds on this foundation of removing emotion. The second piece of advice that Simon says transformed his thinking is this: focus on process, not outcomes. This might sound counterintuitive. Aren't outcomes what matter? Isn't the whole point of investing to achieve good outcomes? Here's what Simons understood that most people miss. In any system involving probability and uncertainty, short-term outcomes are often disconnected from the quality of the decision-making process. You can make a mathematically correct decision and still experience a poor short-term outcome. Conversely, you can make a terrible decision and get lucky with a positive outcome. According to Simons, this distinction between process and outcome is critical for long-term wealth building. Renaissance technologies experienced losing months. Even with their sophisticated algorithms and mathematical models, they had periods where they lost money. But Simons never evaluated the quality of their approach based on short-term results. He evaluated it based on whether they were following their systematic process correctly. Research from the National Bureau of Economic Research supports this framework. A study analyzing decades of investment returns found that skilled managers experience losing quarters approximately 35 to 40% of the time, even when their long-term performance is exceptional. Why? Because markets involve randomness and uncertainty. Short-term outcomes reflect both skill and luck, making them unreliable indicators of process quality. Let me give you a concrete mathematical example. Imagine you're playing a game where you flip a coin. Heads, you win $15. Tails, you lose $10. Mathematically, this is an excellent game to play repeatedly. Your expected value per flip is $2.50, calculated as follows. 50% probability of winning $15 equals $7.50 expected value, minus 50% probability of losing $10 equals $5 expected loss, for a net expected value of positive $2.50 per flip. Now imagine you play this game once, and you get tails. You just lost $10. Does that mean playing the game was a bad decision? Absolutely not. The process was mathematically sound. The outcome was simply one possible result within a range of probabilities. If you played this game 1,000 times, you would almost certainly end up significantly ahead. But any single flip could result in a loss. Simons applied this thinking to markets. According to documentation of Renaissance's methodology, they never evaluated a trading strategy based on whether it made money last week or last month. They evaluated it based on whether it had a positive mathematical expectancy over thousands of trades. A strategy that won 55% of the time with favorable risk-reward ratios would be profitable long-term, even though it lost 45% of the time. The key was executing the strategy consistently through both winning and losing periods, allowing the mathematical edge to compound over time. This framework challenges how most people think about financial decisions. According to research from the University of Chicago's Booth School of Business, most investors evaluate their decisions based primarily on recent outcomes. If their portfolio performed well last quarter, they feel confident in their strategy. If it performed poorly, they question everything and often make changes. This outcome-based thinking ignores the role of randomness and short-term variance, leading to constant strategy switching that prevents any approach from working long-term. Here's where this becomes practical. Let's say you've decided to invest a portion of each paycheck into a diversified portfolio of low-cost index funds, a strategy supported by extensive research from institutions including Vanguard and Dimensional Fund Advisors. You start in January, and by March, the market has dropped 15%. Your portfolio is worth less than you invested. Should you abandon the strategy? Outcome-based thinking says yes, because you're losing money. Process-based thinking asks a different question. Is the underlying mathematical logic still sound? If the answer is yes, if the research still shows that consistent investing in diversified assets produces positive long-term returns despite short-term volatility, then you continue the process regardless of the recent outcome. Simons took this process focus to an extreme. According to interviews with former Renaissance employees published in financial trade publications, the firm would continue executing a strategy even through extended losing periods, as long as their statistical analysis showed the mathematical edge was still present. They understood that variance is part of any probabilistic system. According to quantitative research published in the Journal of Finance, even a strategy with a genuine edge can experience losing streaks that last months or even years, simply due to the random distribution of outcomes. The mathematically correct approach is to stay committed to the process through these periods, not abandon it at precisely the wrong time. The third principle Simons emphasizes might be the most counterintuitive. Embrace ignorance and focus on what you can measure. This sounds strange coming from someone who built an empire on mathematical analysis and data. But here's what Simons actually means. Acknowledge that you cannot predict the future, cannot know why markets move the way they do on any given day, and cannot understand all the complex forces at play in the global economy. Instead of pretending to have knowledge you don't possess, focus exclusively on patterns you can measure and probabilities you can quantify. According to research Simons discussed in various academic settings, Renaissance technologies never tried to understand why a pattern existed. They only cared whether the pattern was statistically significant and whether it persisted when tested against historical data. If stock prices tended to move in a certain way after a specific sequence of events, and that relationship held up across decades of testing, they would trade on it, even if they had no fundamental explanation for why it worked. This approach differs radically from traditional investment analysis. Most fund managers spend enormous time and energy trying to understand the underlying reasons for market movements. They analyze corporate earnings, macroeconomic trends, Federal Reserve policy decisions, geopolitical events, and countless other factors, attempting to build a comprehensive understanding of what will happen next and why. Simons argued this was a waste of cognitive effort. According to interviews he gave later in his career, he believed that markets were so complex, with so many interacting variables and feedback loops, that constructing accurate causal models was essentially impossible. Instead of trying to understand everything, Renaissance focused on identifying robust statistical patterns that repeated themselves with sufficient frequency to be exploitable. Research from behavioral finance supports this perspective. According to studies published by researchers including Daniel Kahneman, winner of the Nobel Prize in Economics, humans are naturally inclined to construct narratives that explain past events. We see patterns and immediately invent stories about why those patterns exist. This narrative-building tendency feels satisfying, but it often leads to false confidence in our understanding. Just because we have a plausible story explaining why something happened doesn't mean we understand the actual causal mechanisms well enough to predict what will happen next. Simons avoided this trap by refusing to rely on narratives. Renaissance's algorithms identified correlations and patterns without requiring explanations. If the data showed that a specific market condition had been followed by a specific outcome 73% of the time across 10,000 instances, that was sufficient. They didn't need to know why. They just needed to know that the pattern was statistically significant and not the result of random chance. Here's where this becomes relevant for typical investors. According to analysis from Morningstar, one of the biggest mistakes individual investors make is constantly seeking explanations for market movements. When the market drops 3% in a day, they frantically search for reasons. Was it inflation data? Interest rate concerns? Geopolitical tensions? They convince themselves that understanding the cause will help them predict what happens next. But according to research spanning decades of market data, daily market movements are largely random noise. Even on days with major news events, the market's reaction is unpredictable. Sometimes bad economic news causes the market to rise because investors interpret it as increasing the likelihood of Federal Reserve intervention. Other times, identical news causes declines. The relationship between news and market direction is far more complex than simple cause and effect narratives suggest. Simons would argue that individual investors should stop trying to understand or predict market movements and instead focus on what they can control and measure. You can measure how much you save each month. You can measure your asset allocation. You can measure the fees you're paying. You can measure the tax efficiency of your investment vehicles. These measurable factors have clear mathematical relationships to long-term wealth accumulation. According to research from the Bureau of Labor Statistics, your savings rate, the percentage of income you invest rather than spend, is the single largest determinant of wealth accumulation for most households. If you earn $50,000 annually and save 10%, you're investing $5,000 per year. If you increase your savings rate to 20%, you're investing $10,000 per year. Over 30 years, assuming 10% average annual returns, the difference between these two savings rates is approximately $490,000 in additional wealth. That's a measurable, controllable factor with a clear mathematical impact. Interesting social experiment. I want to test whether people who think mathematically about money cluster in certain geographic areas. Drop your city and state in the comments below. I'm genuinely curious whether there's a pattern in who resonates with this analytical approach to wealth building. Are you in Austin, Miami, Seattle, Denver? Let me know where you're watching from. The fourth and final principle that Simons says he wishes he'd understood earlier is perhaps the most powerful. Time is your most valuable asset, not money. This requires explanation because it sounds like generic advice. But Simons means something very specific and mathematical. According to his analysis, the compounding function of time makes it exponentially more valuable than any other variable in wealth building. You cannot manufacture more time, cannot buy more time, and cannot recover wasted time. Every year you delay implementing a systematic investment approach is a year of compounding you lose forever. And due to the exponential nature of compound growth, early years are disproportionately valuable. Let me demonstrate this with specific mathematics. Imagine two people. We'll call them Sarah and Michael. Sarah starts investing $250 per month at age 25. She continues this for exactly 10 years, until age 35, at which point she stops contributing entirely, but leaves the money invested. She never adds another dollar after age 35. Michael waits until age 35 to start investing. At 35, he begins investing $250 per month and continues this every month until age 65, a full 30 years of contributions. Both earn an average annual return of 10%. Who ends up with more money at age 65? Most people guess Michael because he contributed for 30 years, while Sarah only contributed for 10 years. But here's what the mathematics reveals. Sarah ends up with approximately $872,560. Michael ends up with approximately $565,064. Sarah has over $300,000 more, despite contributing for only one-third as long, simply because she started 15 years earlier. Those 15 additional years of compounding on her initial contributions generated more wealth than Michael's extra 20 years of contributions. This mathematical reality demonstrates Simons' point about time being the most valuable asset. According to research from Vanguard analyzing retirement account data across millions of participants, the age at which someone starts consistently saving is a stronger predictor of retirement wealth than their income level or investment choices. Two people with identical incomes can end up with vastly different net worth simply based on when they started saving systematically. The person who starts at 25 and earns average returns will likely accumulate more wealth than someone who starts at 40 and earns above-average returns. Time is that powerful. Simons applied this time-focused thinking not just to compound interest, but to learning and skill development. According to biographical accounts of his career, Simons spent decades building expertise in mathematics and pattern recognition before founding Renaissance Technologies. He didn't try to become a successful investor overnight. He invested time in developing deep expertise, knowing that the compounding effect of knowledge would eventually generate returns. By the time he started Renaissance in 1982 at age 44, he had accumulated over 2 decades of experience in advanced mathematics, code breaking, and pattern analysis. That accumulated expertise became the foundation for everything that followed. Research from the National Bureau of Economic Research supports the relationship between time investment and expertise development. Studies analyzing skill acquisition across various domains show that expertise requires not just practice hours, but also years of exposure to different market conditions, problem types, and feedback loops. In investing specifically, research shows that experience spanning multiple market cycles, including both bull markets and bear markets, crashes and recoveries, leads to better decision-making than any amount of theoretical knowledge alone. Time provides something that cannot be accelerated: exposure to the full range of scenarios and the pattern recognition that develops from navigating them. Here's where this becomes actionable for someone starting their wealth-building journey today. The mathematical message is clear: start now, regardless of how small your contributions might be. According to calculations based on historical market returns compiled by the Federal Reserve, investing $100 per month starting today is mathematically superior to waiting 5 years and investing $300 per month. The compounding effect of those 5 additional years generates more wealth than the larger contributions can overcome. If you invested $100 monthly for 40 years at 10% average annual returns, you'd accumulate approximately $637,678. If you waited 5 years and then invested $300 monthly for 35 years at the same return, you'd accumulate approximately $613,504. Starting earlier with less beats starting later with more. Simons also emphasized that time allows you to benefit from variance and volatility rather than being harmed by them. According to research published in the Journal of Portfolio Management, short investment time horizons make volatility your enemy because you might need to withdraw money during a market downturn. But extended time horizons transform volatility into an advantage. Market drops become buying opportunities when you're consistently investing over decades. According to analysis from Dimensional Fund Advisors examining market data from 1926 through 2023, there has never been a 30-year period where a diversified portfolio of U.S. stocks produced negative returns despite multiple crashes, recessions, wars, and crises during that span. Time smooths out volatility and allows the upward drift of productive assets to compound. Let me give you one more mathematical perspective on time that Simons found compelling. According to research he referenced in academic talks, there's a concept in probability theory called the law of large numbers, which states that as you increase the number of trials or observations, the actual results converge toward the expected value. Applied to investing, this means that over short time periods, your returns might deviate significantly from the historical average. You might lose money for months, or even a few years. But as you extend the time horizon, your actual returns tend to converge toward the long-term historical average of the market. Time reduces the impact of luck, both good and bad, and allows skill and systematic process to dominate outcomes. With only a few years of data, it's hard to distinguish between a good strategy that got unlucky and a bad strategy that got lucky. With decades of data, the truth emerges clearly. The financial services industry doesn't emphasize this enough. According to data from the Investment Company Institute, the average holding period for equity mutual funds is approximately 4 years. Investors are constantly switching between funds, chasing recent performance, and reacting to short-term results. This behavior prevents the mathematical power of time from working. If you change your strategy every few years based on recent outcomes, you never allow any approach sufficient time to demonstrate its long-term characteristics. You remain trapped in the realm of high variance and randomness, never reaching the time horizons where mathematical expectancy dominates. Simons himself demonstrated this principle through Renaissance's Medallion Fund. The fund had losing months and even occasional losing quarters. But over 30 years, the mathematical edge compounded into the most successful investment track record in history. The key was time combined with unwavering commitment to process. According to analysis of the fund's returns published in financial research journals, even during their worst-performing years, Simons and his team never abandoned their systematic approach. They understood that short-term variance was irrelevant. What mattered was executing their process consistently over decades, allowing time and probability to work in their favor. Now let's connect all four of these principles and examine how they work together as an integrated framework. Simons didn't view these as separate pieces of advice. He saw them as interconnected elements of a mathematical approach to wealth. Eliminating emotion enables you to focus on process. Focusing on process allows you to embrace ignorance about specific outcomes while trusting mathematical expectancy. Embracing what you can measure rather than what you can predict helps you identify the controllable factors that matter. And recognizing time as your most valuable asset shapes every other decision, encouraging you to start immediately and commit for decades rather than seeking quick results. According to research from the Federal Reserve Bank of St. Louis, analyzing wealth distribution data, households in the top 10% of wealth didn't get there primarily through high incomes. Many high-income earners remain in debt with negative net worth. The distinguishing characteristic of wealth-building households, according to the data, was consistent saving and investing over extended time periods. They automated the process, removed emotion from decisions, focused on controllable factors like savings rate and asset allocation, and most importantly, they started early and never stopped. The mathematics compounded year after year, decade after decade, until the accumulated wealth became substantial. Simons often said in interviews that Renaissance's success wasn't about being smarter than everyone else or having secret information. It was about being more systematic, more disciplined, and more patient. According to documentation of their approach, they would test trading strategies against decades of historical data before implementing them. If a strategy showed a mathematical edge, they would execute it consistently, regardless of short-term results. They never tried to predict what would happen next week or next month. They simply positioned themselves to benefit from probabilities that played out over thousands of trades and many years. The same mathematical principles apply to long-term wealth building for individuals. Here's a specific framework you can use to apply these four principles starting today, based on the mathematical approach that guided Simons throughout his career. First, establish a systematic process for investing that removes emotion from the equation. This might mean setting up automatic transfers from your checking account to your investment account on the same day each month, regardless of what's happening in the markets, regardless of whether you feel optimistic or pessimistic, regardless of recent performance. According to research from Vanguard, automation dramatically improves investment outcomes because it prevents emotional interference. Investors who manually decide whether to invest each month based on how they feel about market conditions achieve significantly lower returns than those who automate the process. Second, evaluate your approach based on whether you're following your process correctly, not based on short-term outcomes. If your process is to invest 15% of each paycheck into a diversified portfolio, then success means executing that process consistently. A month where the market drops and your portfolio value decreases isn't failure, it's just variance within a probabilistic system. According to analysis from Morningstar covering multiple market cycles, the investors who stayed committed to their systematic process through 2008, 2020, and other volatile periods achieved dramatically better long-term returns than those who abandoned their process during scary markets. Third, focus on what you can measure and control: your savings rate, your asset allocation, your investment costs, your tax efficiency. According to research from the Employee Benefit Research Institute, these controllable factors explain far more variation in retirement outcomes than the factors most people obsess over, like trying to pick winning stocks or time market movements. A household that saves 20% of income in a simple portfolio of low-cost index funds will almost certainly accumulate more wealth over 30 years than a household that saves 5% while trying to actively trade or pick market-beating investments. Fourth, start immediately and think in decades, not months or years. According to calculations based on historical data from the Federal Reserve, every year you delay starting systematic investing costs you approximately 7 years of equivalent contributions at the end due to lost compounding time. If you're 30 years old and delay starting your investment plan until you're 35, you don't just lose 5 years of contributions. You lose the compounded growth those contributions would have generated over the next 30 years. The mathematical cost is much larger than it initially appears. If the mathematical framework I just demonstrated makes logical sense to you, hit that like button. Only about 3% of YouTube viewers actually like videos. Be part of that 3%. Show the algorithm that you value content based on research and mathematics rather than hype and speculation. Now I want to address something important. This analysis is for educational purposes only, based on historical data and mathematical principles documented by institutions including the Federal Reserve, Bureau of Economic Analysis, and peer-reviewed academic research. Nothing presented here constitutes financial advice or investment recommendations. Past performance does not guarantee future results. Markets involve inherent risk and uncertainty. Always consult qualified financial professionals before making investment decisions. My goal is to share mathematical frameworks for thinking about money, not to prescribe specific actions for your individual situation. What works mathematically for the average investor over long time periods may not be appropriate for your specific circumstances, risk tolerance, time horizon, or financial goals. The reason I find James Simon's principles so compelling isn't because they generated extraordinary returns for Renaissance technologies, though that's certainly impressive. What fascinates me is that these same mathematical principles, when scaled appropriately, apply to anyone trying to build wealth systematically over time. You don't need to be a mathematician or a billionaire to benefit from removing emotion from financial decisions, focusing on process rather than outcomes, measuring what you can control, and recognizing time as your most valuable asset. According to research spanning decades from institutions like Vanguard, Fidelity, and Dimensional Fund Advisors, individual investors who embrace these principles achieve dramatically better outcomes than those who rely on intuition, market timing, or constant strategy changes. Simons himself has said in multiple interviews that if he were starting over today, these 4 principles would be the foundation of his approach from day one. Not because they're complicated or sophisticated, but because they're mathematically sound and psychologically difficult. The mathematics of long-term wealth building isn't particularly complex. According to analysis published by researchers at MIT and Stanford, the core concepts, compound interest, diversification, cost minimization, and time horizon, are relatively straightforward. The challenge is psychological. Can you remove emotion when markets are crashing? Can you focus on process when outcomes are temporarily disappointing? Can you acknowledge ignorance about future predictions while still taking action? Can you think in decades, when the culture pushes instant gratification. These 4 principles from James Simons represent more than investment advice. They represent a fundamental shift in how you think about wealth, time, knowledge, and decision-making under uncertainty. They challenge the narrative that building wealth requires superior intelligence, insider information, or complex strategies. Instead, they suggest that wealth accumulation is primarily a function of systematic behavior, emotional discipline, and time, factors that are available to anyone regardless of starting income or education level. According to data from the Federal Reserve tracking household wealth over multiple generations, the families that built substantial wealth weren't necessarily those with the highest incomes. They were the families that saved consistently, invested systematically, and stayed committed to their process through multiple market cycles and economic conditions. The question you need to ask yourself after examining these 4 principles is simple. Will you implement them or just understand them intellectually? According to research on behavior change from behavioral economists, including Richard Thaler, knowledge alone rarely changes behavior. Most people understand that saving and investing consistently leads to wealth accumulation. The difference between those who accumulate wealth and those who don't isn't knowledge, it's execution. It's the willingness to establish systems that automate good behavior, the discipline to follow processes even when emotionally difficult, the humility to focus on controllable factors rather than pretending to predict the future, and the patience to think in decades rather than months. These aren't sexy qualities. They don't make for exciting social media posts or dramatic stories. But according to mathematical analysis of what actually builds wealth over time, they're what matters most. James Simons proved that mathematics can decode patterns in systems as complex and chaotic as financial markets. But perhaps his more important contribution was demonstrating that the same mathematical principles, discipline, process, probability, and time, work not just for quantitative hedge funds, but for anyone willing to think systematically about wealth. The returns might be more modest than 39% annually, but the underlying principles remain mathematically sound. Start now. Remove emotion. Follow your process. Measure what matters. And let time compound your efforts into substantial wealth. That's what Simons would say he wishes someone had explained to him when he was just starting out. And based on the research I've examined over the past 6 months, it's advice worth taking seriously.